Welcome to The Explainer. Today, we're diving into the highly complex but honestly completely fascinating Q2 2026 earnings report from Parsons Corporation. Now, if you follow the defense, intelligence, or global infrastructure sectors, you already know Parsons is a massive player. But this most recent quarter? Well, it definitely had a lot of analysts doing a double take. Because on the surface, the numbers painted one picture, but the reality of their operational momentum, it tells a completely different story.
So here's our agenda for today. We'll start with the headline numbers, look under the hood to see what's really going on, break down their segment performance, take a look at how they're winning big with AI, and then finish up with the path forward. Let's get right into it.
Section 1. The headline numbers, which were definitely a quarter of contrasts. At first glance, the reported figures here might actually make you wince a bit. We see a slight dip in total reported revenue, dropping from $1,593 million in Q2 of 2025 down to $1,576 million this quarter. But the real shocker, that would be adjusted EBITDA, which is essentially their core cash profit. It took a staggering 72% plunge, falling from $149 million all the way down to just $42 million. And if that wasn't enough, they also reported a $15 million net loss.
So this brings up a rather crucial question, right? How in the world can the company's management confidently claim they had solid revenue growth and demonstrated resiliency when the headline numbers look exactly like that? I mean, it seems like a massive contradiction, doesn't it?
Well, that leads us right into Section 2, looking under the hood at their $118 million pivot. You see, when you look past the standard GAAP accounting numbers and strip away some one-time charges, their adjusted EBITDA didn't actually plummet to $42 million at all. In reality, it increased by 8% to a very healthy $161 million. And not only that, but their profit margin actually expanded by 0.7% to hit 10.1%. So you're probably wondering, where exactly did that massive gap come from? The answer lies in $118 million worth of strategic charges. Think of these charges kind of like pruning a tree. Parsons took a $77 million loss by divesting from certain held-for-sale contracts. Essentially, they're just cutting off non-core branches. On top of that, they absorbed a $41 million charge on a joint venture program that got severely delayed by historic, unprecedented rainfall, which just goes to show that sometimes even major defense contractors are totally at the mercy of Mother Nature. But basically, they took all this pain at once to allow the most profitable parts of their business to grow unhindered.
This short-term pain of restructuring is actually a highly disciplined strategy. Parsons is deliberately shaping its portfolio. By shedding less profitable or non-aligned contracts right now, they are ensuring long-term sustainable growth across their specialized divisions. It's that classic case of taking one step back to take three giant leaps forward. Moving on to Section 3, Segment Performance Breakdown, comparing federal versus infrastructure.
Now that we've factored in those strategic actions, this side-by-side comparison shows some really robust health in both areas. Federal Solutions generated $778 million in adjusted revenue. That's an 11% increase. And they're boasting a massive 1.3x book-to-bill ratio. Put simply, for every single dollar they billed, they booked $1.30 in new work. Meanwhile, critical infrastructure grew 5% to $815 million, maintaining an incredible 11.9% adjusted margin and a very healthy 1.1x book-to-bill. So both engines of the company are absolutely firing on all cylinders here.
Which brings us to Section 4, Winning Big with AI. Let's look at some rapid-fire proof points.
You see, those high book-to-bill ratios we just talked about, they aren't accidents. It's really no secret why they're winning in such a competitive landscape right now. Parsons is aggressively integrating advanced AI into their mission-critical defense and infrastructure solutions. In fact, 4 out of the 5 contract wins over $100 million this quarter specifically include advanced artificial intelligence components. They aren't just building infrastructure anymore, they are making it smart. Let's dive into some of those rapid-fire proof points that demonstrate this tech-forward dominance, and we'll start with a pretty massive $400 million win. Parsons was awarded $400 million in other transaction agreements, or OTAs. Now, for those of you familiar with government procurement, you know that the word fast isn't usually in their vocabulary. But OTAs are used specifically when the government needs advanced, cutting-edge solutions deployed to the field rapidly. These have a quick 3-year period of performance, and Parsons already booked $125 million of this just in Q2 alone. These OTAs really prove the government has immense confidence in Parsons to deliver next-generation defense tech and deliver it fast.
But they certainly didn't stop there. Let's look at an even larger figure that really showcases their absolute dominance in the cybersecurity sector.
U.S. Cyber Command just announced their intent to increase the ceiling on the Joint Cyber Hunt Kit contract to a staggering $750 million. This is for deployable hardware and software that's used in active cyber warfare operations. It is a massive testament to Parsons' ability to deliver incredibly sophisticated, scalable cyber capabilities to the absolute highest levels of the defense apparatus.
And honestly, these rapid-fire wins are just drops in a very, very large bucket. Parsons currently has a staggering $55 billion pipeline of potential work. And even more impressively, that pipeline has remained above $50 billion for 11 consecutive quarters now. The demand for their highly technical solutions is just relentless and totally sustained.
Let's wrap things up with Section 5, the path forward, looking at their FY26 guidance.
So how does all this incredible AI and cyber momentum actually translate into the financials for the rest of the year? Well, their guidance assumes a really clear, steady ramp-up. Step 1, they project Q3 will provide a solid 3% sequential revenue growth over Q2. Step 2, they expect Q3 adjusted EBITDA to hit about 30% of their full-year target. All of this sets the stage perfectly for Step 3, which is a highly profitable Q4 that pushes them to their full-year guidance midpoints of $6.35 billion in revenue and $530 million in adjusted EBITDA.
I want to leave you with this final thought today. Parsons is sitting on a war chest of $11 billion in contract wins that haven't even been booked into their backlog yet. When you consider that massive reserve, combined with a freshly optimized portfolio that's been cleared of its underperforming branches, you really have to ask yourself, just how much higher can Parsons' core business climb once this strategic pivot is fully realized? Thanks so much for joining me for this explainer, and definitely keep your eyes on those unbooked wins in the quarters to come.